we have a risk system. Okay, we've got 8 different risk systems, and these risk systems are ultimately designed to guide you towards what is the optimal amount of risk you should use based off of probabilities and volatility and all sorts of variables. Okay, so the point is they spit out a number. They basically just say to you, hey Brannigan, you're doing this S&P 500 trade called breakout, use 5 lots. Okay, now ultimately, risk events, things like an OPEC announcement or thing like, an ECB member comes out and says, look, September we're hiking rates. I don't know what Lagarde's talking about. We're going to have to hike again. Those sort of risk events, unfortunately, you can't put those on the risk manager because you don't know when they're coming. Okay? And here's the key. What traders typically do when they have these risk events in mind is they execute what they believe to be a leveraged position. All right, so it's a pure discretionary overconfidence bias idea that they come to. In other words, they hear this news and they'll suddenly click 50 lots. Okay, now let's use the example. Normally your position will be 5. Because of your overconfidence, because of this news, because of your belief that this is market moving, you use 50. We've got a 10 times leverage position. Okay, now I know 50% of traders that'll tell me that is the right thing to do because you need to take advantage of the high probability situation. And I'll push back on that and I'll say that's 100% the wrong thing to do. And I'll tell you why. What the 50% of traders that say it's the right thing to do miss out on is that, sure, there is a high probability that the market will move in one direction. Okay, there is that high probability. But guess what? There's a very small probability that something can go wrong. Now that probability could be 0.5%, it could be 1%, it could be 2%. Okay, but I know from personal experience in 2015 that I did one of these risk event things. I went long 40 lots in the Eurodollar FX on a news announcement and I got stopped out in a white box event. In other words, the market shut. I couldn't get out of the position. And when the real news announcement came, I was screwed. I was 240 odd prices offside on a 40 lot. I literally wiped out 60-70% of my account. And then I proceeded to wipe out my account in the month ahead. The point is, I ended my career because I never factored in that there's always a probability that I could be wrong. Okay? And that's crucial to understand because guess what? I heard about the exact same thing happening to 5 traders about 2 months ago, which is they had this high probability play. They went balls deep on it, thinking, well, the probabilities are very much in our favor, and we have wiped out accounts. Okay? So it's not to say that the 50% who say that's the right thing to do are wrong or right. It's to say that there's a degree of risk you need to be applying, and I think that's the key to answer the question, which is, if I'm typically using 5, does it make sense for me on a very high probability outcome to use 10? Yes, it does. 100% it does. Okay, does it make sense for me to use 15? Yeah, I think so. I think 15 is still within the realms of a good leverage position where I can still take advantage, but I'm still safeguarding and managing risk. Does 20 make sense? Yeah, I think that's debatable. Okay, does 25 make sense? That's where we start to think, okay, 5 times more leverage than normal. What does that mean relative to my daily stop? That's where things start to become questionable. So I think to answer your question, it's very simple. It's a personal thing, but it's something you do need to know the answer to. I like the idea of using 4 times what's normal because I'm comfortable with that. Okay, so if normal for me, a normal clip is a 5 lot, 20 is right for me. Okay, now one other last thing I'll say to you is keep in mind, never forget this, and I'm giving you a free lesson here. The day you use that 50, okay, you're not used to using 5. The day you use that 50, how do you think you're going to react as the market's moving in a volatile fashion? The simple answer is you're going to shit yourself. Okay, and if you go just 1 or 2 prices offside, all you are thinking about is exiting the trade. You're not even thinking about what's just come out. You're not even thinking about interpreting it. You're just thinking about scaling out. So ask yourself this. If you reduce that position to say half, do you think you'll stay in that trade longer? Do you think you'll interpret that trade a bit longer? And do you think you'll profit out of that trade idea in the long run more frequently? The simple answer is we all agree yes. Why? Because the psychology can handle 5 times leverage. the psychology can't handle 10 times leverage so well. And that's crucial to understand. And most traders don't ever think about that until they're in that situation, they make the mistake, and then they're forced to take the loss as a result.